Appreciate you joining in. Good speaking with you. 90 points on the Nifty. So slowly, but it's moving higher. Still away from the day's high, which was, of course, the open. But let's see if we're able to get there. Trideep Bhattacharya is Chief Investment Officer, Equities at Edelweiss Asset Management Company. He's joining in now. Trideep, good to have you with us here. Thank you very much. You know, I was just, before coming in, looking at just valuations 1 year forward, that is FY24. And we're now at about 17.5 times FY24 earnings. The last 10-year average is 17 times, almost exactly 17 times earnings. With this 4.5% correction in the last 5 or 6 days, you know, we are back to the 10-year average. How do you think about valuations now, Trideep? That's the bigger question. I mean, would you kind of look at this where we are now compared to the average, or is that a moving number based on what where you are on earnings? What's your sense?
Good afternoon, and thank you very much for having me on your show. And I would say that the absolute valuations was actually less of an issue all the time. It has probably gotten in our favor over the last week or fortnight of correction that we have seen. Our issue historically over the last 6 months has been the relative valuations relative to the other emerging markets. And that is where we saw a bit of a flow out of India into other emerging markets. But of late, given how the headlines have come out of China reopening, this, that, the other, the headlines have been showing slightly slower growth. So overall, net-net, it's a far more balanced situation. So I would say on net balance, in answer to your question, that while absolute valuations are in line with average, the relative valuations, we are probably still a little bit on the expensive side, but we are gradually getting to a level where all the markets would be seen with regards to the fundamental earnings growth that we will see, and in which case India stands out still quite well.
Trideep, any thoughts on oil marketing companies? With the sharp precipitous decline seen in crude prices this week, Brent is now almost at $75 per barrel. Oil marketing companies like BPCL have re-rated. The marketing margin picture is going to look much better. UBS recently indicated that this quarter in Q4, it could be the best earnings quarter for oil marketing companies in the last many quarters. Is this a tactical play for you?
Sure. I think clearly the factors that you talked about, will play out in the near term and will lead to a bump up in earnings in the OMCs overall. However, one has to balance this near-term positivity with regards to the fact that we are gradually heading towards an election year. And generally, if there is a bit of populism, then some of these gains to be passed on to the end customer could be another issue to contend with. Maybe not immediately, but about 6 months down the line. So I think from a trading standpoint, clearly kind of near-term bump up in earnings mean better for the share prices. But from an investment standpoint, given that they are still PSUs, and from a PSU basket, the minority shareholders, how they get treated over a period of time needs to be balanced overall. So from a trade perspective, yes. From an investment perspective, we need to evaluate other factors as well.
Trideep, hi, good afternoon. Surabhi here. Just want to get your house call on IT. There is so much news flow and so much going on. The underperformance, then the headwinds of the recession, and most of these companies undergoing some form of a management change, maybe top level, maybe tier 2. So how are you looking at the sector, and does it make the cut and make it to your portfolios?
It does. And I think on net balance, we went underweight the sector about 1.5 years ago, September of year before. And roundabout from September, about a year from then, we have been cutting our underweight position. As we speak, we would be neutral to maybe marginally overweight IT services in our various portfolios that we run. So on net balance, I would say that incrementally through this correction that we have seen, we've actually turned a little more positive than what we have been. But is it an outright overweight call? Not yet. Because I think overall, the calibration of demand with regards to the earnings estimates for FY24, which is a year ahead, is yet to happen. And I think if you give it a month, which is probably April, May, by that point in time, all of this would be realigned. So that will be a lot better time visibility-wise. prices maybe will probably get a little ahead of time. So you have to balance, how you see the outlook as well as versus how you see the numbers coming out. Now you may have the prices, later on you might have better visibility. So I think on net balance, incrementally positive, but we are not yet majorly overweight the sector, but looking for incremental adding to weights.
Okay, so can I then ask you, what is the sector that gets the top billing for you? What would your key overweights be in a market which is dealing with so much of news and noise?
Absolutely. I think it's a great question. I would say that particularly in times like these, one has to sort of start with a medium-term hat and then tweak the portfolio with regards to near-term to kind of, manage the damage, if I may call it that way. And from a medium-term standpoint, what still sticks out quite well for India is the infrastructure, capital goods, and the private sector capex cycle, which will likely to happen over the next 2 to 3 years. It's a multi-year theme, and we continue to remain meaningfully overweight across our portfolios in whatever shape and form that we can get our hands to on various market cap ranges. The second area that we are also quite positive on are very bottom-up India-specific themes like indigenization of defense, beneficiaries of government growth schemes like PLI. On net balance, we think that 2023 would be probably kind of, a time where bottom-up factors will drive a lot of earnings, and we'll have to count on that rather than the macro tailwind. We think that macro could be headwinded, particularly in the first 6 months of the year overall. So those would be a few areas that we would be kind of, overweight in our sector. I think the rebound in credentials in financials has by and large kind of, played out to a certain extent. We still continue to like the sector, but less so probably than about 3 to 6 months ago. So those would be the areas that we are kind of, positive on.
All right, Trideep, we'll leave it there. Thank you very much. Good framework, and as always, good getting that perspective for our viewers from you. Thanks indeed. 100 points, so slowly inching higher, 17,100 almost is what we have. I mean, we'll come back and we'll put out the stocks which have also suffered the maximum damage. I was just looking at, this latest leg of fall, which started from last Wednesday, which has been very steep every day, except, of course, these bounces like today, which are the large cap names and which are the mid cap names which have seen a fair bit of fall. So we'll do that. We'll also, of course, get you a check on what's happening in dealing rooms on D Street Chatter and buy today, sell tomorrow calls with our technical experts as well. Stay with us.